Hi everyone, so today we're going to be covering a new company. It's going to be a stock analysis video for Allegro MicroSystems. And Dom's going to cover the analysis of the company and then the earnings for Q2 of 2026. Dom, whenever you're ready.
Thank you, Matt. All right, can you see my screen?
Yes, perfect.
Cool. So the first article we're looking at just kind of gives like an overview of the company and what they do. So to quickly summarize, Allegro Microsystems designs, develops, manufactures, and markets sensor integrated circuits, and they can call that ICs for short throughout the rest of the paragraph. And application-specific analog power ICs for motion control and energy-efficient systems. Its products include magnetic sensor ICs such as position, speed, and current sensor ICs, power ICs comprising motor driver ICs, and regular and LED driver ICs, and photonic and 3D sensing components, including photodiodes, eye-safe lasers, readout ICs for LiDAR applications. The company sells its products to original equipment manufacturers and suppliers, primarily to automotive and industrial markets, through its direct sales force, third-party distributors, independent sales reps, and consignments. It operates in the U.S., rest of the Americas, Europe, Japan, Greater China, South Korea, and other Asian markets. Man, they really love saying IC. It's a good thing they cut down on that one for this paragraph. So as you can see, they are kind of worldwide, and most of their products do go in a lot of pretty big industries, industrial, automotive, things like that. So let's jump into our results for Q2 2026. This article is a bit older. It's from the end of October, so we're looking at about 5 weeks ago, just about. So not the most freshest article, but the data is still relevant for our purposes. So let's jump into it. Net sales were at 214 million, a 5% sequential increase and 14% year-over-year growth. Non-GAAP earnings per share is at 13%, a 44% sequential increase and 63% year-over-year growth. Gross margin 49.6%, increase of 140 basis points sequentially. Operating margin, we're at 13.9% of sales, up from 11.1% in Q1 and 11.7% a year ago. So good to see. Adjusted EBITDA, 19% of sales. Automotive sales increased 8% sequentially and 12% year over year. E-mobility sales increased 21% year over year. Industrial and other sales did decline by 1% sequentially and grew to 20, but did grow 20% year over year. Distribution sales increased 22% sequentially and 23% year over year. Magnetic sensor sales increased by 1% sequentially and 2% year over year. Power product sales increased 13% sequentially and 42% year over year. So as you can see, the vast majority of their areas are growing year over year and have increased sales and revenue. The only one basically it seems like that is declined was industrial and other sales, but even that wasn't too much, only 1%. So not too bad. Cash flow they say is at 20 million. Free cash flow they say is at 14. Cash balance 127 mil. Total debt balance is 285 million with net debt at 168 million. They're saying Q3 2026 sales outlook expected to be in the range of 215 to 225 million. Gross margin outlook for Q3 2026 to be between 49 and 51%. And then finally, non-GAAP earnings per share outlook expected to be 12% and 16%, or 12 cents and 16 cents per share. So overall, Q3 it was Q3, right? Q2, excuse me. Q2 2026 wasn't too bad. Most things up,
Yeah,
especially year over year, which is great. Only real, seemed like real dip was industrial, but not a bad quarter. Not a bad
nice.
quarter
Yeah,
at all.
I agree.
So I'll let Matt kind of take over and talk about the current financials, and we'll take a deeper dive into that.
Okay. Thank you, Dom. Great analysis.
Thank you.
All right, so we're going to go ahead and we're going to first see how simply, there's an ad for Tipranks, but first is Simply Wall Street. And Simply Wall Street is going to be spectacular, to be quite honest with you. It's 56 million in current free cash flow. In the next 3 years, it's going to be 244 million. So again, we're looking very, very good here. This is an incredible rate of growth. So really good in that front. Financial health. The financial health of the company could use some work. As you could see in 2024, they took a bit of dip at cash. The debt is now higher than the cash, which is in a great position, and you even have it here. So you have to be a little bit cautious with that. So just keep in mind. However, it kind of overlaps, or the DCF overshadows everything else because it's saying that it is overvalued by 29%. however you really look at it. So you do have to be careful that the shares are currently overvalued. And if we use historical growth, it's even worse. It's 73% overvalued, which I don't believe. I think Wall Street is correct. It's 15%. So this 73 is ridiculous. I think it's like 20, 30% overvalued, like Wall Street forecast is saying for this. So keep in mind of that. And I know for Tipranks as a fact, it's going to be a strong buy. And I actually am not going to agree because it's 34% upside. Let me reload it. Keep reloading it. And yeah, it's 34% upside. We're trading at $20, 29 bucks a share. And yeah, so you have to be a little bit careful. I do like the company, but it's just that I think just based off the DCF, it's overvalued. But the future free cash flow growth is very good, to be fair. So, Dom, was there anything you wanted to add?
Uh, nah, there's not too much else I can think of to add to what we've already discussed.
Okay. All right. Thank you, Dom. Thank you, everyone.
Thank you.